Good evening, everyone. Thank you for taking the time to join us. If we could move to the next slide, Paulina. So just as a quick introduction, Rob Abraham, I'm the fund manager for Supermarket Income REIT at Atrato Capital, which is the external manager of SUPR at the moment. But of course, we had our shareholder general meeting this afternoon on the prospective internalisation of the company. The results will be formally announced tomorrow morning, but I think it's fair to say investor feedback over the last couple of weeks has been very positive. So as you can imagine, we've been expecting a good level of support. Following that, I will become CEO of SUPR. I've spent 6 years with Atrato growing SUPR from when I joined 7 supermarkets to now 82 today, including some across UK and France. So I've been here for that journey of the growth of the fund. On to the next slide, please. So just as an introduction for those of you who are maybe less familiar with the story, we've got a focused investment strategy targeting long inflation-linked income, and that is from investment-grade tenants, the leading and largest grocery operators. And we have our weighting is towards Tesco's and Sainsbury's with those dominant market shares and investment grade covenants, which just gives you a really secure income profile. We target future-proof stores. Now, these are omnichannel stores, so they fulfill your traditional in-store shopping, but also online home delivery. And that's a key part of the strategy for us, is capturing that increased volume that's been going through online. And lastly, that real asset backing with large flexible sites. So we have 9-10 acre sites typically on average. These are large format supermarkets, and they turn over a significant amount of revenue for the operators. So they are mission critical to those businesses. So then just to dive into the portfolio in a bit more detail, as I've mentioned, 82 supermarkets. They are valued as a 6% net initial yield. That's very much an average. That yield ranges from 5 out to 8%. 94% of those stores are omnichannel, and we've got that 79% of our income is investment grade. And you can see there, Tesco's at 45%, Sainsbury's at 32%. As I've mentioned, that clear weighting to the best operators. We also added Carrefour with those stores in France, 5% of the portfolio, but again, a leading investment grade operator. So that's a core part of our strategy. So then what do we mean by these omnichannel stores? So this is an example here of Tesco in Thetford, and this was the first store that SUPR actually acquired. And it's a great example. You can see in the satellite there, large format store, large car park, but we've also broken down the component parts of that revenue. So £70 million a year of revenue for Tesco. It makes it one of its top trading stores. It just means that your tenant is not going anywhere because it's a critical part of their store network, and you just can't get another site of this size. In terms of that £70 million of revenue, it's broken down. Around 70% or so comes from in-store. Home delivery at about 15%, probably nudging up to more like 20% these days. And click and collect at sort of 5, maybe 10% as well, given the growth we've seen in that channel. And then petrol station sales. Now, we don't include petrol station sales when we're assessing the performance of the store, but it is a nice to have for the operator. It helps to drive footfall, but the store manager will not be assessed on petrol station revenues. So then when we look at the store characteristics, and what we've done here is we've zoomed out that satellite image on the left, you can see surrounded by residential catchment, but also 5,000 new homes under construction immediately adjacent to the store. Clearly, the more of the focus for local authorities is on house building, not on building new large format supermarkets. So planning is an obstacle, and what it means is that can they realistically find another 13-acre site and build a new large format store? Probably not. So it just means that the existing estate becomes increasingly valuable. We've got 13 home delivery vans operating from it, which makes it quite a large online hub. And that if we were to zoom out the satellite again, what you would see is that there are no other large format Tesco omnichannel stores for a good 30-minute plus drive time. So it just means that the value of this store is in the immediate catchment and acting as that last mile distribution hub. So then just coming to the current state of affairs. So we're positioned for growth. We've had another period of operational strong performance, and that's supported by a resilient underlying grocery sector where we've got some of the strongest tenants, or some of the strongest operators in the grocery space as our tenants. We've made significant progress on our key strategic initiatives. We announced a number of initiatives in November last year, and I'll come on to those in a moment. But the most meaningful or the most material of those has been our most recently announced internalization, which leaves us well positioned for future growth. And now for those of you which are less familiar with the term internalization, the current structure of SUPR is that there is an external manager. SUPR pays a management fee to Atrato Capital as its manager. As part of the internalization, the team that supports SUPR transfers across to become employees directly of SUPR, and therefore it no longer pays that management fee. So just turning the page to get into some of those strategic initiatives in a bit more detail. Well, the first of those was cost reductions. As I mentioned, these were announced in November last year in an RNS, and we've made some really good progress. So the first was cost reductions. Now, there had already been an announced change to the management fee construct, which was voted on at the AGM in December. That reduced our management fee by £2 million a year. The internalisation will save a further £4 million. So total cost reductions of £6 million. That allows us to now have a target EPRA cost ratio of below 9%, which would put us firmly amongst the sector leaders. And we hope to get there in fairly short order. Lease renewals. Now, one of the questions that most commonly comes up is around the degree of over-rentedness in our portfolio and the extent to which rents will need to rebase to the correct affordable level. Now, what we have shown through these lease renewals with 15-year leases is that our stores will command much higher rents than the wider market might be anticipating. Capital recycling has been another focus for us, and what we've been able to do there is make a disposal of an asset back to Tesco and recycle some of that capital to generate earnings accretion. And the last one on this page, and I will come on to all of these in more detail, but the last one is on a strategic joint venture, which again will present a further capital recycling opportunity. And we hope to have some news on that in the coming weeks. So just on this page, you can see in that gold bar there, all of this is designed to drive earnings growth, to enhance long-term dividend cover, with the aim of bringing that all together to close the current discount to NAV. And that's the real priority for us. And certainly in the last month or so, we've seen some positive share price momentum, which in part has been off the back of the announcement of the internalization. So now on to the financial results, and I'll just cover some of the headlines, and perhaps to the extent it's helpful, do fire away with questions if there's any areas to dive into in more detail. But net rental income up 10% to 58 million. Now, that was in part driven by acquisitions, but also we get contractual rental uplifts on the portfolio. The majority of our leases are inflation linked, so we get that contractual growth coming through. The EPRA cost ratio has further improved to 13.6%. That's down 1.5%. And as I've already mentioned, we're targeting further improvement there. EPS of 3p, up 3%. Importantly, giving us a fully covered dividend. Portfolio valuation of 1.8 billion. That was up 0.5% on a like-for-like basis, but really the message there for us is that we have seen valuations find the floor in the higher interest rate environment. We are now confident that valuations have found that floor, and that's why we've been confident taking the LTV up towards that 38% current level. We've got an EPRA NTA per share of 88 pence. And again, that was marginally up from where we were. So coming on to the balance sheet, and we benefit from a BBB plus investment grade credit rating from Fitch. That was reaffirmed earlier this year. Average debt term is 3.7 years, and we are looking to term some of that out, and I'll come on to that in a moment. But we've got 87% of our debt is unsecured. That debt is more flexible, and also actually broadly similar, if not a bit cheaper than secured debt. 93% of our debt cost is fixed. Now that fixed cost rolls off over the coming 2.5 years or so. And what we're seeing is our debt cost step up from the current average fixed cost of 4%. That debt cost will step up as those hedges unwind. But actually, this comes back to the point of us targeting that earnings growth. What we are looking to do is grow earnings to offset that higher cost of debt and ensure that the current dividend remains sustainable. And last point on there, I've already mentioned that 38% LTV, which we're very comfortable at that level, given the investment market activity we're seeing. That gives us absolute confidence both in valuations, but also that the direction of travel should be for valuations to move upwards in the future. So coming back to those strategic initiatives, first of all, it was the cost reductions. The most meaningful of those is the internalization, and this delivers significant benefits for SUPR, firstly on the financials, but there's also strategic benefits. So as I mentioned, £4 million a year of savings annually. EPRA cost ratio of one of the lowest in the sector at below 9% target. Now, this is the third point here is an interesting one, that greater balance sheet flexibility. Under the prior structure, we couldn't have been able to issue longer dated debt because it would have been prohibitively expensive. What we are now able to do by reducing the cost base, the administrative cost base, that gives us a capacity to ultimately pay a higher cost of debt. So we can now look at 5-year or 7-year bonds at around 5.4% all-in cost. And that is a level that is sustainable for SUPR. So we are exploring that. Another benefit of the internalized structure is that increased alignment between the company, its management, and shareholders. And there is always a question mark under the external management structure around that alignment. And even if you're at the better end of the external management structure, the question will always exist as to whether the incentives for the manager are the same as the exec team. By being internally managed, we're able to have that much clearer alignment, and the board is proactively speaking to major shareholders to get their views on exactly how the incentivization should work with things like LTIPs. We also have a more simplified structure. It's easier to understand. It's easier to ultimately navigate. But also through this transaction being agreed between the SUPR board and the owners of Atrato, we've been able to secure the specialist team and the platform in what's actually been a really efficient and collaborative transaction. And it just means that we're able to be off and running in a very short space of time. The decision to internalize was made at our board strategy day at the start of February. And here we are approaching the end of March, and we should be completing on it next week. So it really has been an efficient process. The last point on this page is about the broader investor appeal. And now there is, particularly for overseas investors, there is a bit of an aversion to external management. We recently did a secondary listing on the JSE with South African investors. And it's quite clear that they've had their fingers burned in the past by poorly incentivized external managers. You get similar feedback in Europe. You get similar feedback from the US investors. So by moving to the internalized structure, we just take that off the table. And as I say, it broadens the investor appeal. And all of that taken together, again, is designed to drive liquidity into the shares. Now, we've mentioned that EPRA cost ratio target a couple of times, but just to highlight there, you can see that target on the left at sub 9%. Best in class in the sector is 7.6%, but of a much larger scale vehicle. My ambition is to get us down to that kind of level in the future by growing and scaling the platform, but also being really efficient in how we manage costs. Now, talking to capital allocation, what you can see on this page, the internalisation has an all-in cost of, call it £20 million to achieve a saving, to achieve earnings of £4 million a year. That £4 million gives us then a yield on that cost of about 19%. And that is just far ahead of any sort of return we could generate, whether it's through share buybacks in the middle there at 8%, whether it's in terms of unlevered IRRs on acquisitions at 9%. The internalisation is by far the most accretive use of the capital we have available. Now on to lease renewals. So some of the, I guess the question marks around SUPR has been around affordable rents and over-rentedness. And when we say over-rentedness, what we mean is that the contractual rent has run ahead of where the affordable rent should be for that store. Now, the point for us is the market has very much overbaked that. We see some really good value in stores that are perceived by the wider market to be over-rented. And what we have proven by renewing the 3 shortest leases in SUPR's portfolio is that our stores will command higher rents than any of a kind of broad market average. So we renewed the leases for 15 years, and that's with annual inflation-linked uplifts. The average rent reduction on those stores was 20%, but the point there is the market was perhaps anticipating that the rent reduction would be much greater. Our average rent to turnover is 4%. This is the affordable benchmark for the operators, and something we've been talking to for a long time now is the way to assess the correct level of rent on a supermarket is relative to its trading performance. If you own the better performing stores, you will achieve a higher rent. And that has been proven by the last 2 boxes on this page. The rent's being 35% above where the MSCI supermarkets ERV would have indicated. Now, the MSCI is a broad market average. It is not reflective of our portfolio, and we have proven that with this. But also importantly, those rents have reset 13% above where the valuer's estimate of ERV was. And the point there is valuers are too conservative. And so we've just proven that actually there is some upside there. And as a result, following these lease renewals, the valuations of the assets will increase in the mid to high single-digit percentages. So just demonstrating that potential upside in our portfolio NAV. So why do our stores achieve those higher rents? Well, on the left-hand side of this page, you can see this is from Tesco's latest results. You can see that by channel, large format stores up 4.2%, online up 9.3%. That is far ahead of convenience, which if you were to read in the UK press about the growth of the operators into convenience, you might think that convenience was where the growth is. It's not the case. The largest growing channels are large format and online. That combined is omnichannel stores. So what you can see on the right-hand side is how that translates into an actual example from our portfolio. You can see rental growth there of 4%, which is inflation linked, hitting the cap at 4%. But importantly, that store turnover is growing at 4.9%. So it's growing ahead of the rents. And it just means that it ensures that our rents remain sustainable. So now capital recycling. So we've been able to sell above book value, and that supports our portfolio valuation. So it demonstrates there is upside again in the NAV. We're then able to redeploy that capital to enhance earnings. In this case, some of those proceeds have been allocated towards the cost of the internalisation, but we've also got other opportunities. But all the while, whilst we're recycling that capital, we're able to maintain the robust credit strength of our tenants, which is a really important part of our story, is maintaining that secure income profile. So then the example here of a selective disposal of one of our lower yielding assets was Tesco in Newmarket. We sold this back to Tesco for £63.5 million. That's at a yield of 5.2%. And really, this just highlights the critical nature of omnichannel stores to the operators. They are ultimately, we own some of the best performing stores, and it's our tenants who also want to own them. It tells you how they're thinking about the future role of the large format store in their business. There was a period of time where people thought online was all going to move to the Ocado model, the dark stores. This just tells you that isn't going to happen. If Tesco's spending £60 million buying back a store, it tells you how they're thinking about it. So we sold at a level which was 7.4% premium to book value. And as I mentioned already, that those proceeds gives us optionality for the redeployment in the future. That will, all options are on the table, whether that's share buybacks, store purchases, debt repayment. We will consider the relative merits of all of that. So a couple of examples on the opposite side of the equation. So I just took you through a disposal. This is what we've been acquiring. Sainsbury's Huddersfield, 7.6% net initial yield. This is the perfect example of an over-rented store that the market is believing the rent will reset to a lower level than we know it will. And we've proven that through our lease renewals. We know the rents will reset to a level that is higher than the rest of the market might expect. But you've got an investment grade tenant. It's an omnichannel store, a large format hub. And then on the bottom of the page, the Carrefour portfolio. So another tranche of Carrefour sale and leaseback, smaller format stores, right sized for their catchments. But the benefit here is you're acquiring it at 6.8% net initial yield, but your cost of debt is much lower in euros. So we're financing it at 4.1% for a 7-year term. And so you just get that really attractive spread to your cost of debt coming through. But you've also still got your investment grade tenant. You've got your omnichannel stores. It ticks all the same boxes for us. Carrefour is an investment grade BBB rated tenant. It's got a 21% market share in France. It looks the same as Tesco's and Sainsbury's ultimately. Now, joint venture. So the last of our strategic initiatives we announced back in November, and this is the one we haven't yet demonstrated any tangible progress on, but I would hope to have some news for you in the coming weeks. This shares some of those same benefits as single outright store sales, supports the portfolio valuation because we'd be transacting above where the assets are marked in our books. It also gives us that financial flexibility. In the short term, we can take the cash and pay down debt, and that then gives us capacity to redeploy that capital elsewhere. Now, the benefits that joint ventures have over single store sales, by contrast, though, is you're able to scale the business through third-party capital. Raising money in the equity markets at the moment is not an option for us, given where the share price is. So by scaling through this third-party capital, we're able to then access a larger portion of the pipeline now than we otherwise might be able to. And also it's supporting that investment thesis there. We've got a credible third party, which is supporting our views on the returns of these assets. We're also able to generate a management fee. So on the element of the stores that we don't own, we'd be paid a management fee, which is also then enhancing to earnings. And lastly, we're able to retain ownership. So by doing a 50-50, we have a longer term pipeline opportunity to buy in the remaining 50% interest as and when the JV partner might be open to exiting. So supermarket investment yields, and what you can see on this chart is supermarket yields have reached the same peak we saw in the global financial crisis, 6.3%. Clearly in the GFC, you saw rates come down rapidly, and that meant that yields tighten rapidly. We're not seeing that same rapid path to lower rates, but what we are seeing is the investment market activity that gives us confidence that yields have peaked. We all obviously, of course, hope that the path to rates is lower. What you can also see on this chart is Super's net initial yield is 6%, reflecting the stronger asset quality of Super's portfolio, but also supermarket net initial yields are above that of all property. So what that means is supermarkets are providing a greater proportion of its return through income. And income is, of course, more certain. Whereas in the all property case, and a lot of that will be weighted towards logistics and industrials, you need to believe in a much higher rate of rental growth, market rental growth, to achieve the same return that we can achieve on supermarkets. So then, just to take you through those some transactional evidence, which are deals that have happened away from super. Now, these are deals that we, of course, considered for super. On the left-hand side, you've got a Sainsbury's in Wantage, which was acquired by a local government pension scheme for 4.6% net initial yield with a 25-year lease term. Now, what that shows you is that there are buyers at that tighter yielding end of the market. They don't use debt, so they're just buying into that long-term IRR return of the asset class. Moving up the yield curve, you've got ICG, bought Sainsbury's in Halifax at a 6.1% net initial yield. That's got a 14-year lease term, and it is a bit over rented, hence the slightly higher yield. And lastly, Tesco Congleton, again, a bit over rented, but also only 7 years left on the lease, trading at a 7% net initial yield. And Tesco is one of the biggest buyers we see in our space. Of course, every time they buy a store, it's gone from the market for good. And that strapline at the bottom there is this competition for assets that we're seeing that provides that upwards pressure on portfolio valuations. So we believe there is upside in the NAV. So Super's investment case, we just feel actually is as strong as ever. We've got fundamentally a defensive sector, which is resilient throughout economic cycles. You've seen that through the periods of really high inflation recently. You've seen it throughout the pandemic. These are really resilient businesses because of the non-discretionary spend that supports them. We've got highly secure income. 79% of the portfolio is investment grade. We've got excellent visibility of income alongside that, with a 12-year average lease term, and 81% of that is inflation linked. So again, really good visibility of that growing income stream. We also own future-proof stores. We've mentioned that they act as last-mile omnichannel fulfillment hubs. And what that means is, by having that future-proofed aspect, as we're seeing online volumes increase, it's our store revenues that are growing ahead of the total market, and that ensures that our rental growth remains sustainable. So bringing all of this together, we're well positioned for future growth. We operate in the resilient and highly attractive grocery sector. Our focus is on enhancing earnings and closing the discount to NAV or to NTA. And to achieve that, we're targeting further progress on our strategic initiatives. So just to take you through over the page where we see those. Perfect, thank you. So near-term deliverables, we've had an incredibly busy last 6 months. We've got an equally busy next 6 months ahead. First and foremost, delivering the internalisation of the company, which should complete next week. But following that, we'll also be looking to pursue the change of listing fairly rapidly. We need to deliver on the strategic joint venture, and then in doing so, in realising some of the proceeds, we will be reviewing all capital allocation options, whether that's share buybacks, asset acquisitions, debt repayment. And lastly, as I mentioned, we'll be looking to refinance some of our debt, our maturing debt, and extend the weighted average maturity of that by doing some long-dated bond issuance. So I think over the page, the next one is just the slide for Q&A. So thank you very much for listening and for joining. I will open it now to questions.
Thanks very much, Rob. Good summary of the situation. I think we've got some questions coming in, but everybody on the line, do keep typing away with your questions, and we'll try and get through as many as we can. Oh, my video's not started. Come here, try again. Keep clicking on it, but it won't work. So sorry, you're going to have to see me in. You're going to have to listen to me, but can't see me, so for some reason. But
No problem,
Don't know
mate.
what's gone wrong there. Okay, we've got a couple of questions already here. One from Mark saying, given lower euro debt rates, have you considered raising more debt in euros and hedging currency risk to sterling?
Yeah, and so the approach we have taken is that our investments in Europe, because we've got the triple B plus credit rating, we're able to borrow on an unsecured basis at the PLC level. Now, what that means is that we're able to effectively asset and liability match in euros. So we have borrowed 100% LTV against the investments in Europe. And what that means is it gives you a really neat currency hedge. Our FX exposure is only on the income gap between, or the spread between the 6.5% or so yield on the assets and the 4.1% cost of debt. So it's only on that small amount of income that there is any FX exposure. I think if we were to over lever beyond the 100% in euros, it would probably raise a few eyebrows in the market, and investors would become, I think, probably fairly rightly concerned on the potential for FX exposure down the line by being over levered in euros. And I mean, it's a bold assumption, but if you assume that the market is efficiently priced, then the cross-currency swap between FX and sterling should offset the financing benefit, the difference in rates in the two markets. So that's the approach we've taken, is the 100% leverage. And as it stands, because the currency exposure on the income is relatively low, we haven't hedged that. If it grows to become a more meaningful portion of the portfolio, then we'll look to hedge that.
Okay, thank you. Question here from Chris. Several of your larger institutional shareholders have reduced their holdings. Can you explain why?
Yeah, well, I guess what have we seen in the UK market? I think you've seen UK institutions rotating out of real estate. Real estate has ultimately been out of favor. What we have been working hard to do is to change the narrative around super to be more positive, and internalization is a big part of that. We know one of the drivers of super's discount, it comes back to the strategic initiatives. The drivers of super's discount have been where the investors have had question marks or concerns around over-rentedness, around long-term dividend cover. So that's why everything we're doing is designed to answer those points and prove to the market that those concerns are overbaked, because that should ultimately help us close the discount. And so far, since we announced the internalization, the share price is up about 10%. We've benefited from a general kind of improvement in sentiment, I guess, across the sector. You've seen some of the M&A, you've seen some of the shareholder activism. But actually, even taking that into account, our share price has had an even bigger boost than that. So I think that is a reflection of the messaging that we're putting out there is working and is being well received. And my ambition is to make sure that where we've seen shareholders reduce holdings or exit the register is getting them back on the register, or certainly finding other new investors to replace them with. And that was the driver behind the JSE listing, as I say, behind us looking to change our listing from chapter 15 to chapter 6 to give us broader access to institutional buyers. So yeah, absolutely front and center for us is closing that discount, and a key part of that is getting new shareholders onto the register. Is the reason I'm doing events such as this, but we're also traveling around the country, we're traveling overseas, we're making sure we're seeing as many current and prospective holders as possible. It's one thing ensuring that current holders are happy, but it's also very important to make sure we've got new holders coming onto the register.
Okay, what is a much of interest? Roughly what percentage of your shareholders are institutions?
Well, so if you look at our share register, actually, our number one holder at the moment is Hargreaves Lansdown. Which is up to about 8% of the book. So retail is now making up a big weighting of our book. So if I look down the register, actually, across Hargreaves Lansdown, AJ Bell, Interactive Investor, those kind of retail platforms, that probably represents, off the top of my head, pushing 20% of the book these days.
Right.
And then you've got, because of our size and our scale on the FTSE 250, we get a decent amount of passives. And again, this is off the top of my head, I would suspect that maybe say 30% of the book might be passives, and then maybe 50% of the more kind of institutional holders. A large proportion is wealth managers.
Right.
And if you look at SUPR, right, we provide that really secure income that's really well suited to ISAs and pension portfolios. So that's why we see across both wealth managers and retailing platforms a big holding.
And they're primarily looking for yield, are they, rather than growth?
Well, we know the income part of our story is a really important piece for investors. It's why we are absolutely focused on ensuring that the current dividend is sustainable and covered. And again, looking at some of the drivers of the discount to NAV in the past has been, can we sustain the dividend? Were we under pressure to cut it? And that's why internalization has been such an important part of demonstrating to the market that we are not under pressure to cut the dividend. The next phase of that journey, once we've done some of that debt refinancing, once we've done some of the capital recycling and proven that the current dividend is sustainable, then the next question on that is where does the growth come from? And that will be the next priority for us.
Yeah, because I noticed your dividend historically has been pretty flat until the last couple of years, and it started to index up. And I guess you want to make that a progression over time to attract people.
Exactly that. The point for us is dividend growth has been more modest in the last couple of years because we've been countering the higher cost of debt that we've had to face into, and the dividend growth therefore has needed to be a sustainable level. But that is not the ambition. The ambition has to be getting back to being able to grow our dividend more in line with the rental growth we see on the underlying portfolio. To get there, we need to continue to grow earnings and churn capital and scale the vehicle, but that absolutely has to be the ambition.
Okay, thank you. Just a definition check here. Ray wants to know, could you just explain to people who may not know online what EPRA cost ratio is in a bit more detail?
Yes, so the EPRA cost ratio, when we quote the 13.6% currently, that is our administrative cost base relative as a proportion of our annual rental income. And it's a way that property companies are compared across the market. So EPRA is the European real estate body that these metrics are designed to provide comparability across real estate companies. As you would expect for Supermarket Income REIT, we have triple net leases where our tenants are responsible for the obligations of ensuring the properties maintaining the capex on the properties is the tenant's obligation. Therefore, our cost ratio should always be at the lower end. But even still, our ambition is to be clearly one of the lowest in the sector, and that's why we've set a target of sub 9%. We are looking to continually drive that cost efficiency in the business and be one of the best in the sector. It's just a way of assessing how efficient you're being with your cost base. And for us, as I say, with triple net leases, we should be one of the leaders in the space, but that's absolutely our ambition.
Okay, thank you for that. Paul wants to know, Asda reported about to start a price war. We've all seen the news on that. Supermarkets' own profits may come under pressure. How do you stop this spreading to rents?
Yeah, so I guess the point here is UK grocery has always been one of the most competitive markets in the world. It's no surprise that Asda is having to now fight to get some of its market share back. They will ultimately sacrifice profits in the near term. But what history shows you is that doesn't go on forever. Ultimately, the equity holders in Asda need to generate profit. They will have to forego it in the near term because ultimately they've done a pretty bad job of burning their reputation with UK consumers who are actually incredibly savvy on when it comes to who's the most competitive on price, who's got the best availability of products. It being Asda and Morrisons, they have been value-led oriented operators. They've lost that reputation to the discounters who've been in a very aggressive growth path. So Asda has had to front into potentially a price war. It won't last forever. We have long dated leases and the 4% affordability benchmark relative to turnover. Yes, it's also relative to store profitability, but again, this comes back to you need to own some of the best performing stores because you will achieve the higher rents. So look, I don't think there's any kind of threat to our rents. There will always be pressures on profitability, and it will ebb and flow for the grocers. Things like national insurance changes. Ultimately, who pays for it in the long term is UK consumers, because these are relatively fine margin businesses. These businesses need to generate a return for equity holders, and to do that, you cannot sustain a price war. So Asda will need to do it to win some market share in the near term, but fundamentally, it won't last forever, I guess.
Okay, that's a shame for me as a consumer.
Yeah, as I say, it's consumers. It's the point with all the government changes. It's the consumers that'll pay.
Yeah. At the end of the day, Taha wants to know: would you grow your real estate portfolio used by tenants outside of the supermarket spectrum? For example, large infrastructure, data center usage from 6% of the total portfolio to a larger number?
So I guess there's a couple of points here. The 6% that we have at the moment is co-located with some really strong supermarkets. The opportunity set for us there could be, we've already owned a number of retail parks that are grocery anchored. There could be some opportunity to grow a bit more in that space. Would we move into other sectors? No, I think investors like our focused strategy. We will certainly always be kind of retail led and mission critical retail led, and that's ultimately supermarkets or grocery anchored retail parks. So no, I wouldn't expect us to be moving into completely different sectors. There's also a point on relative value here. We get Tesco's and Sainsbury's covenants at a 6% net initial yield. If you're in a data center with an equal covenant, I would be fairly certain the net initial yield on that would be some way tighter than what we can achieve. So coming back to my earlier point of our higher net initial yields means you get a higher weighting of your return to income, which is just more certain. And when we're an income vehicle, that's then really attractive.
Okay, thank you. David says you have sites in the UK and France, but when looking for new opportunities, how far and wide do you cast the net?
So the move into France was something that was very carefully considered. We did 12 months of work understanding the geography, the lease structures, and building that relationship with Carrefour. The attraction of that transaction was it was a direct sale and leaseback with the operator. A key part of our story is the relationship we have direct with Tesco's and Sainsbury's. So by doing a sale and leaseback, we've been able to build and establish that same relationship with Carrefour. And so that was the opportunity for us. I would not be expecting us to be diving into lots of new geographies. As I say, it takes a huge amount of work. As it stands, it's only 5% of our book at the moment in France. So there is capacity to do a bit more there. I would describe that as taking it to a critical mass, where we need to really, as I say, for that 12 months of work, the structuring, the costs of it, you need to get the return on that by scaling that investment. So we would probably take that up towards, say, 10% of the book. And I wouldn't expect us to be going up beyond 10% anytime soon. There is, for us, it provides a really attractive spread, but in terms of that yield versus the cost of debt, but we wouldn't have done it as purely an economic play. This was about a continuation or expansion of our strategy in the UK, but the direct sale and leaseback with the operator was a really key part of that.
Okay, thank you. And then Nicholas actually asked a very similar question, so I think we answered that one as well. Just a reminder, keep the questions coming in. I got a couple for myself here that I don't know SUPR that well, but I'm trying to get my head around what's the secret sauce here that means you can do this better than anybody else in the market, because you say you're getting better yields, you're getting better resale value for sites you're selling off, etc., than you're getting in book and so on. So there's a lot of positive stuff, but how do you do it? What's the secret?
Yeah, and I think this comes back to being sector specialists. So it's having those relationships with the tenants. It's if we're buying a store that the market perceives to be over rented, well, we can have a conversation with Tesco's and Sainsbury's and get a feel for how it performs, how important it is to them, get a feel for where the rent might reset to in 5 years' time when you re-gear it. And the point with grocery is actually there's no single data point or metric that makes a good store or bad store. Trading performance is a key part of it. but you really need to understand the local catchment, the demographics. You need to understand where are the alternative locations that operator has to serve that catchment from. If a store does online, it doesn't make it necessarily a good store. It might do online fulfillment because actually it's massively oversized and it does no in-store trade. So they just use it as a last mile distribution unit. And when the lease comes up, they'll either just close the store or they'll want a big discount. So you can't buy these assets just because it has a 15-year lease to Tesco's and Sainsbury's. You really need to underwrite the store specifics, and part of that is being able to speak their language when you're speaking to the operators, when you're speaking to the store managers. So that, I guess, is our point, is having done this now for the last 6 years and bought 75 of the supermarkets we own, you really get a feel for all of that. We spent the day on the road with the Tesco senior property team a few weeks ago, and we went and saw 6 of their stores, some good ones, some bad ones, and just really had a whole day of understanding how they think about the stores, where they're making the investments, things they've trialed and maybe haven't worked, what makes a good store for them that you might not think about. So it's that insight that I think allows us to unlock value. Now, that isn't to say we will never get it wrong, but if I'm an investor, you see some spend £50 million on a store because it's got a 15-year lease to Tesco. But you need to know where that's going to go at the end of the lease. Chances are we should get it right as sector specialists. But if you only own one store as part of a portfolio, that's quite a big point risk. Whereas for us, we own that diversified portfolio. That means even if we get 1 or 2 wrong, you should be able to weather it. If you get it wrong and you only own one supermarket, that feels like quite a bit of risk to me.
Yeah. So it's total focus that you've had on the sector is giving you a better judgment than perhaps others would have on these opportunities.
Mm-hmm.
Okay. I've got a couple more here. Mike Newell, will the internalisation cause any redundancies at SUPR current staff? I don't know whether you've even discussed that internally, so you may not wish to announce anything here and now, but...
Well, what I would say is actually one of the kind of benefits of doing the internalisation the way it has been agreed as ultimately an amicable deal between Atrato and SUPR is that actually we've been able to secure the team of specialists that have been growing this vehicle for a number of years. And actually, we've got all the core team that's across fund management, asset management, finance, and investor relations. All of the team that has been dedicated to SUPR at Atrato transfers into the new vehicle. So for me, that's a real positive, is that we're able to take the team with us. So certainly no plans on that front.
No plans on that front at the moment. Okay, thank you. And John wants to know, can you say more about the rationale for the Joburg listing and what is the annual cost of being listed there?
Yeah, so the Johannesburg Stock Exchange has done a fantastic job of making it incredibly easy to do a secondary listing. It's been a really smart move on their part, actually, to kind of make their market so viable. So actually the cost is very low. The ongoing cost, I think, is only about £20,000 a year. And then you have some travel costs because you go and see the investors and you do the roadshow in the same way we do the roadshow around the UK. But other than that, the costs are very low. We listed in December. So that was just before the South African summer holiday. And so what we've seen since really kind of late January or so, we've started to see their investors coming back to the office and picking back up the story. So too early to kind of be able to point to any hard numbers on the buying activity, but I'm hopeful. There's the rationale really there is you've got capital controls in South Africa that mean only there is 60% of capital has to remain domestic. Now, by being on the JSE, you are treated as domestic investment. So you can access this broader pool of capital, and they have a really well-educated real estate specialist investor base. And we provide an 8% or so dividend yield in a hard currency of sterling that provides them a hedge against the rand. So there is real drivers for the South African investors to buy into us. And as I mentioned earlier, we know sentiment towards UK real estate towards real estate in the UK has been generally weak from institutions. So opening us up to a broader pool of investors potentially then provides that capital in the absence of buyers in the UK. Well, some additional buyers from South Africa the aim is to ultimately provide that additional liquidity in the shares and generate some positive share price momentum. So watch this space. I would hope by the time we come back with our full year results in September, we may have started being able to see some of that bear fruit. But yeah, we can maybe give some more then.
Okay, thank you, Rob. Well, it looks like we're all out of questions and we're just rapidly approaching 6 o'clock. So that's perfect timing. So thank you very much for taking us through the latest. It's been must have been a pretty busy day for you today with the meeting this morning and everything. So I assume congratulations are in order, and I look forward to seeing how you do in the new job, although it looks a lot like the old one, I'm sure, but a different side of the fence. So good luck with that. Wish you all the best, and maybe get you back later in the year to hear how things have been moving on.
Absolutely. Well, thank you very much for having me. Thank you for all the very high quality questions as usual as well. So thank you.